Good afternoon. Welcome to our virtual class in your subject BAFM 6102, and this is Financial Management. Our discussion today is about financial requirement and sources, and that is week 4 module of this course. And I'm your professor, Susan Maminta from AMA East Rizal branch. This discussion is very important, especially if you want to start a business. So you need to know about the different sources of capital. So in our discussion this afternoon, you should be able to know the financial requirements of a business, identify the general sources of finance, and classification on the sources of financing. The financial needs of a business can be categorized into two. One is fixed capital requirement, and the second one is the working capital requirement. In order to start a business, funds are required to purchase fixed assets such as land, building, plant, machinery, furniture, and fixture. This is termed as fixed capital requirements of the company. The funds required in fixed assets remain invested in the business for a long-term period of time. In accounting, we call this as capital expenditures for these purchases. While a working capital requirement, no matter how small or large a business is, it needs funds for its day-to-day operations. The fund is known as the working capital. This is used for holding current assets such as inventories of materials, bills, receivables, and for meeting current expenses like salaries, taxes, etc. So what are the sources of financing? Generally, it can get funds from security financing, internal financing, and loan financing. Okay, so let's discuss this security financing. So if the financing is mobilized through the issuance of securities such as shares and debentures, it is called as security finance or corporate securities. This includes ownership securities, or capital stock and creditorship securities or debt capital. Ownership securities is commonly called as shares, which includes ordinary shares, preference shares, no-far shares, and deferred shares. On the other hand, creditor shares includes debenture and bonds. So let's talk about this securities financing. So what is ordinary shares? Ordinary shares are also called common shares. It gives the owners the right to vote. While a preferred shares, there is a higher claim on assets and earnings, but they don't have these voting rights. And no-for-value shares means no stated value on the shares of stocks. And a deferred share is a kind of shares in which dividends are only paid after all other classes of shares have been paid. So for example, you have these ordinary shares, preferred shares, and deferred shares. So the first shares, the first dividend to receive are the preferred shares holders, followed by ordinary shares holders, and the last is the deferred shares holders. Debenture is a medium to long-term debt which have no collateral backing, while a bonds is a fixed income instrument that represents a loan made by an investor. It includes end date when the principal of the loan is due. Another two sources of financing, in general terms, are internal financing, which is already operated and may get funds internally from retained earnings. And when we say retained earnings, this account is an account maintained by a corporation type of business. Another general sources of financing is the loan financing. This loan financing is a type of financing that borrows money with interest from financial institutions such as banks and other credit unions. The sources of financing that I have just mentioned can be classified further into these classifications. One is based on period, another one is based on ownership, and the last one is based on the source of generation. So for based on period, our sources of funds are based on the terms of payment by the borrowers. So on the basis of period, the different sources of fund can again be categorized into three. And these are the long-term sources, the medium-term sources, and the short-term sources. For a short-term sources of finances, these are required for a period of not exceeding 1 year in terms of payment. And for a medium-term sources, these are those which are required for a period of more than 5 years. Or rather, it can be paid within a period of more than a year, but not exceeding 5 years. Because when you exceed in 5 years, this is no longer a medium-term sources of fund, but it is already categorized or classified as long-term sources of finances. So based on ownership, on this basis, the sources can be classified into owner's funds and borrowed funds. Owner's funds are those provided by the proprietors for a sole proprietorship business and partners for a partnership type of business, and shareholders of an entity are those who own stocks from a corporation. While a borrowed funds refers to the funds raised through loans or borrowings. The last classification are based on the sources of generation. And this basis of categorizing the sources of funds can view whether the funds are generated from within the organization or from external sources. So again, when it is internal sources of funds, that means the funds are generated internally, which have the same characteristics of own capital that we have mentioned for sole proprietorship, partnership. And this includes the retained earnings. And with this, there is a reduction or control in working capital or sales of assets. So this retained earnings is an account used by the corporation for the accumulated income or loss of the business. So if the company needs more funds, they can resort to this sales of assets. Or they can have this sales of their stocks to the public. In this external sources of funds, meaning outsiders of the organization or third party will provide the needed funds of the company. There are disadvantages of borrowed capital. One is the principal and interest obligations have to be paid regardless of the economic condition of the company. Whether you are gaining or losing, you have to comply with the agreement of paying your obligations on time, or else you will have this default risk, or you will suffer for more penalty, and that is a cost to you. And another disadvantage is that in borrowing, some restrictions in the indenture agreement may be a burden on the firm. As this has compliant with the agreement, whether you have that money to pay all the debt, but paying that earlier only incur additional expenses to you because of the service charge that you may incur because of terminating earlier the agreement. Another one, another disadvantage, because of there is a available debt to you, then it weakens the outstanding ordinary shares. Because that debt means more supply of ordinary shares of stocks to the market, because you're not offering that stocks to the market because you have this debt as the sources of your fund needed. So another one disadvantage is this long period. So if you have that agreement that paying that in a long period, then terminating that, as I have said earlier, that paying that or pay that in full and earlier than what you have agreed upon with the lenders, then it might be another cost to you because you have to shoulder the service charges. So in taking the this borrowed capital as the source of your funding, then you must be aware that there are disadvantages, especially the financing charges. Okay, to summarize, that In classifying the sources of financing, you have three classifications based on ownership, and under based on ownership, you have two classifications, that is owner's fund and borrowed fund. And for a classification that is based on period, this is period of payment. You can have this classification short-term, medium, and long-term. And for a classification based on the source of generation, these are the internal sources and the external sources of your fund. Okay, so that's end my discussion this afternoon. And again, class, thank you for listening.